I'm Adrian Finnegan, and this is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, the Iran war is pushing the world's biggest economies to their limits. From the US to China to Europe, all are at risk, but which is more exposed? And what are governments doing to protect people like you and me? The conflict has already caused the biggest energy supply shock in history. Oil prices are surging and growth forecasts are being slashed. Is the global economy heading for stagflation or even recession if the war drags on? All eyes are on the Strait of Hormuz. The longer it remains effectively closed, the greater the damage to the global economy. Iran continues to block tankers from shipping close to 20% of the world's oil supply. That's roughly twice the disruption the world suffered during the energy shock of the 1970s. Big oil shocks have historically led to major economic turmoil, high inflation, stagnation, even recession. Oil and gas prices are already surging, and economies are expected to slow. From American consumers to Chinese factories and European households, people across the world are already feeling the impact. So, how exposed are the major economies, and are we heading for a global economic crisis? Fintan Monaghan reports.
The crisis at the Strait of Hormuz has the global economy on edge. Iran has effectively closed the vital shipping lane, cutting off oil and gas flows from the Gulf to the rest of the world. It's led many policymakers to warn of the danger of stagflation. That's when three things come together: high inflation, high unemployment, and slow economic growth. It means people will have to pay higher prices, they face greater risk of losing their job, and it might prove harder to build up savings. Stagflation is a rare phenomenon. Usually, high inflation is only a problem when the economy is booming. But a sharp rise in the cost of oil is threatening to push up the price of everything, right when many economies are slowing down.
In our country, inflation is plummeting, incomes are rising, the economy is surging.
US President Donald Trump is downplaying concerns, but the numbers are troubling for the American economy. Petrol is a key indicator of inflation. The week before the war started, the average price was around $2.98 per gallon. It's already jumped to more than $3.50. Some economists say it could soon hit $4 if the crisis drags on. Inflation fears come as the rest of the economy is looking shaky. In February, the US economy lost 92,000 jobs. The stock market has dipped since the crisis began, a sign investors are nervous. And bond yields are up, an indication that the cost of borrowing money may be on the rise, along with mortgage rates. Europe may also be vulnerable. The Eurozone grew by 1.5% in 2025 and is just emerging from a series of economic shocks in recent years. In 2022, the Ukraine war saw a spike in European energy prices as the bloc shifted away from Russian energy imports. In 2025, US President Donald Trump imposed stiff tariffs on European imports, before eventually reaching a trade deal. And now, in 2026, the Iran war is once again imposing economic uncertainty. And with high borrowing costs and government debt at historic highs, there's less European nations can do to protect consumers. China was also facing challenges before the war broke out. Its growth target for 2026 was between 4.5% and 5%, the lowest in decades. Efforts to stoke domestic demand have been mixed, and it too has faced pressure from aggressive US trade policies. But in some ways, China is less vulnerable than other major economies. While others have had to deal with inflation, China has struggled with deflation. China has also built up the world's largest oil reserves, which may help cushion the impact of the Iran war for a while at least. If the major global economies are headed towards stagflation, there's limits to what central banks can do. Raising interest rates could get inflation under control, but lower economic growth. Lowering rates could boost the economy, but it might make inflation worse. Members of the International Energy Agency, including the US and many European economies, agreed to release 400 million barrels of oil from their emergency reserves, a move which may help stabilize oil prices, but only in the short term. If the Iran war drags on, so too will the disruption at the Strait of Hormuz. And the pressure on the global economy continues to grow. Fintan Monaghan, Al Jazeera, for Counting the Cost.
Well, Asian economies import much of their oil through the Strait of Hormuz, but some are more exposed to the crisis than others. Japan and South Korea have large amounts of oil stockpiled, enough to last more than 200 days. But nations in Southeast Asia have much smaller reserves. They're taking steps to make it last and to stabilize their economies. The Philippines holds reserves for around 60 days. It's moved to a 4-day work week in a bid to conserve energy supplies. Myanmar has put limits on motorists, only allowing people to drive on alternating days. Indonesia, the region's largest economy, is an oil producer, but still imports more than 1/3 of its crude. Oil companies there have started to declare force majeure, indicating they may not be able to fulfill their contracts. And Thailand has banned most oil exports and put price controls over the cost of fuel. The government is also encouraging people to work from home and to limit their travel. Let's bring in our panel of experts. Greg Swenson is founding partner of Brigg McAdam, which is a London-based merchant banking firm. He's also chairman of Republicans Overseas UK. He's joining us today from Chicago. In Beijing, John Gong is a professor at the University of International Business and Economics. And in London, we're joined by Mushtaba Rahman, who's the managing director of Europe at the Eurasia Group, a political risk consultancy firm. Great to have you with us, gentlemen. Greg, let's start with you. The US, of course, the world's biggest economy. How much pressure is it under right now, and how much worse could things get if this war drags on?
Well, we're not under much pressure here in the U.S., and I think it's more perception than reality. In fact, as you mentioned, the U.S. is the world's largest energy producer, and we're exporting 4 million barrels a day. We're producing 13.6 million barrels a day, and more importantly, natural gas is, we've also the largest producer of nat gas. So, and that's because natural gas is priced in local markets. We are relatively unaffected here in the U.S. It's maybe a different situation with oil because it's priced globally, but we're still energy independent for the most part. So any sort of movements...
Greg, I'm sorry to interrupt you. As we heard in our report, though, gas prices in the US are already rising. If the US is energy independent, why is that? Why are consumers already feeling the pinch?
Well, that's a great point. And look, because oil is priced globally, even though we're producing almost all of our oil here in the US or in Canada, it shouldn't be affected. However, because it's priced globally, it is. But that considered, gas is up. Gasoline prices are up to $3.70 roughly a gallon here in the U.S. That's up from $3. Yes, that's difficult. Higher prices are going to pinch consumers. However, relatively speaking, if you look at the average price in 2022, it was $4. In January of 22, it was over $5. It was $5.02 a gallon. Even pre-Ukraine invasion in 22, it was $3.30. So, relatively speaking, this is not that big of a deal. Yes, we're higher, but compared to what the Biden years, when we were not producing as much energy, when we were very hostile here in the U.S. to the energy sector, gasoline prices were higher. So, we're not that worried about it in terms of the near-term effects. We don't expect this to be a long-term trend.
All right, John, in Beijing, Greg isn't worried there in the US. How concerned are you there in Beijing? China talks up oil sufficiency, but for how long? It's the world's largest importer of crude oil and is heavily dependent upon the Middle East. That's a strategic vulnerability, isn't it?
Well, before I talk about China, let me just add a few sentences about the United States. I think the country, United States, may not be under big pressure, but President Trump himself is under big pressure for political reasons, for two things. One is that the idea that the United States started a war and didn't win the war conclusively, that's a huge blow to President Trump's political capital. The second thing is American people are concerned about getting into a forever war again. they're concerned about the prospect of putting boots on the ground, which will take years and years, and see American soldiers coming back in body bags. This is the big concern. I think President Trump is under huge pressure right now.
All
Now,
right.
speaking of China,
John, hang on a second, John. I'm just going to throw that back at Greg, because you're one step ahead of me. I was going to come back on Greg with comments about President Trump, but I can see him both laughing and shaking his head here. I mean, this is risky ground for President Trump. This issue of the president who talks up peace and apparently solves or stops wars, has begun one. It could dominate the rest of his term here, and if it does go badly for the economy, he could be remembered for the guy who crashed the economy.
Of course, there's always risk, and I think the president is a risk taker. However, by most metrics, we have won the war decisively. Right, we're in the process of opening up the Strait of Hormuz. By every other military metric.
John, Greg, I'm sorry, sure. I'll come back to Greg. How can you say that? I'm speaking to you from Doha, where day in, day out for the past 2 weeks, we've had alerts and missiles being intercepted overhead. Yeah. This morning, it wasn't my alarm that woke me up to come to work. Right, it was the national alert saying that there was another incoming Iranian missile, which was intercepted.
And I don't want to minimize.
You're saying that you've won the war already. You clearly haven't.
The regime is desperate and are firing missiles from the very few places that they still have the capabilities to do that. But 95% of their offensive capabilities have been destroyed. So this is a regime on the very tail end of a desperate situation where they're firing missiles, randomly, and firing drones randomly. But 95% of their offensive capabilities have been destroyed, and they don't have any defensive capabilities remaining. So, this is the tail end of a war that the U.S. is
very briefly, Greg.
Don't worry about boots on the ground.
The risks for President Trump and the U.S. economy.
Very minimal, because again, we're not as dependent on imports as the rest of the world. Again, I don't mean to minimize the difficulties for some of the countries who are dependent on imports, but the U.S. economy is not. And again, we've hit these gas prices before. Oil was well over $100 during the Arab Spring. During the Biden years, when we were not a net exporter of energy, things were inflationary here. So you saw higher oil and gas prices, higher natural gas prices, and gasoline prices. That's not the case now. So I don't see a long-term trend here for the U.S. economy. That's not to suggest that oil importers won't suffer.
John, back to you in Beijing. I don't want to get too bogged down in the politics here. I want to focus on the economics of this, the economic fallout. So tell us more about the situation in China.
Well, I think the supply of oil to China is indeed affected, but I think it's very limited in a very limited way for several reasons. First of all, we still have full access to very affordable Russian oil. We can easily make up the reduction in oil supply from the Persian Gulf with the oil from Russia. That's the first thing. Second thing is that China is probably is a country that has the world's largest oil reserve. We have an oil reserve for 3 to 4 months. Most countries only have a 1 month of oil reserve. So I think we have a huge cushion here that we can make up the shortage of oil. The third thing I want to mention is that it's been widely reported that since the war began, the Iranian oil supply to China is actually increasing, as opposed to decreasing. When we talk about the closure of the Strait of Hormuz, I think we're really talking about a selective closure. It's not across the board. I mean, the Iranians are indeed letting some ships pass while stopping others. So I think, from these perspectives, I think the impact is still very limited. Having said that, though, I think the impact on countries of our neighbor, like Japan and South Korea, industrialized countries heavily relying upon oil supply from the Middle East, that's a real impact. I don't want to deny that. It's a huge impact for these two countries. All
right, let's bring in Mushtaba. Thanks for your patience. To what extent is Europe the most vulnerable of the economies that we're talking about here?
The Europeans are certainly vulnerable, and I think they will become more vulnerable depending upon both the duration and the extent of the war. I disagree with your first speaker. I think there is absolutely a risk the war is now moving into a more escalatory phase. A lot of discussion about the US seizing Kharg Island in order to gain more leverage over the regime in Tehran, in order to bring it to bear and stop its asymmetric attacks in the Straits of Hormuz. No willingness from the Europeans to support President Trump's demand that they facilitate safe passage through the Straits of Hormuz until the hot phase of the war is over. So I think there is an economic risk for Europe. The fiscal picture, I think, is more challenging than it was in 2022, where you saw there was both a tailwind from the recovery, from the post-COVID recovery. There was the Next Generation EU 750 billion investment facility. State aid rules were completely suspended. The fiscal framework was completely suspended. I suspect this time around, depending upon how long the war rolls on for, you'll see much more targeted fiscal support because the public finances are in a much more challenging position, and it will not be broad-based because there'll be a lot of concern about doing anything that further exacerbates the outlook for inflation.
Yeah, I was going to ask you, after a period of stagflation, Europe had hoped to accelerate rate growth this year. If that targeted aid ends up costing a lot, what's that going to do as far as derailing growth?
I think as I say, a lot depends on the duration and the extent of the war, but you're certainly seeing central banks completely rethink their rate trajectory. Look at the Bank of England, look at the European Central Bank, where a number of rate cuts were priced in for the year. Now we are potentially looking at rate hikes towards the end of the year. And so growth was already incredibly mediocre. Obviously, the bloc is absolutely struggling under the weight of a number of competitiveness challenges vis-a-vis the US and China. And this will not facilitate or enable better economic outcomes. And so, of course, there is a fiscal challenge, there is an economic challenge, and EU leaders that are convening in Brussels later this week, I think, will take the measure of the conflict and I suspect will begin to debate accordingly what the appropriate policy response is.
Greg, you're painting a very positive picture given the circumstances. All right, prices are rising. They may not be, when we're talking about gas prices, as high as they perhaps once were, but higher consumer prices, of course, could increase the risk of stagflation in the US when stagnant economic growth exists alongside high unemployment and higher inflation. Do you admit that at least that is a risk?
Sure, there's always a risk of inflation because gasoline prices or petrol, for consumers is a big part of the CPI or a big part of the budgets for consumers, no doubt. Oil would have to be over $90 a barrel for 3 or 4 months before it would, you could increase gasoline prices to roughly $4. So yes, that's a possibility. I don't think it will last that long. And so I don't think we see a risk of $4 gasoline. But I think for the rest of the economy, besides the consumer with filling their gas tanks in their automobiles, besides that, again, you've got massive supply of oil into the U.S. economy and natural gas as well. Natural gas is a big part of the economy now. So I think, generally speaking, if you look at the overall risk, we don't have that problem of inputs of oil and gas inputs. Yes, there's always that risk, and then you have to look at the context of everything else that's going on. You're seeing pretty impressive GDP growth in the U.S. Over the last few quarters, but also forecasted for this year. And then look at the context of the other factors: tax reform, massive deregulation, and massive foreign direct investment and business investment at home. So, I think collectively, okay, higher oil prices are never good for economic growth. But if you look at the total inputs coming into the economy and the tax reform and deregulation, I think we're in really great shape here in the U.S.
John, China's latest 5-year economic plan emphasizes increasing consumption as a share of GDP, but with rising energy prices, will Chinese economies be encouraged to spend right now? They're reluctant enough as it is with all that's going on in the Chinese economy. What measures will China be taking to insulate its economy and get Chinese consumers to start spending?
Well, certainly there are some lessons here to be learned. We learned that energy security is very important. We cannot rely too much on external sources. We view this very differently, I think. We view this as an opportunity. The country is already transitioning towards renewable energy sources. In any case, China is definitely indisputably leading in solar energy, leading in wind power energy. So, this is an opportunity that further accelerates China's transition towards that direction. I can guarantee you, the number of cars being sold that are EV cars as opposed to ICE cars, ICE meaning internal combustion engine, right now in China is just happening very, very rapidly. And within the event in the last few days, with the gasoline price just rising just a little bit, I think a lot of households are rushing out to buy electric vehicles as opposed to ICE cars. So I think this is a more of opportunity. And I think the entire energy supply structure in China is under a huge transformation right now.
Mujtaba, Europe has been trying to wean itself off of Russian gas since 2022. It still relies heavily, though, on imported energy. It's more reliant upon American LNG right now, but the price of that is soaring too. Can Europe afford that?
So as I said, I think the fiscal picture is certainly more challenging than 2022. But when it comes to energy infrastructure, I think Europe is actually in a slightly better place to weather this energy shock than was the case 3 or 4 years ago. There's not one overarching solution to the energy supply crunch, but I think across a range of potential policy responses, Europe is in a slightly better place. I think you have seen the EU engage in gas to coal, switching for the purposes of power generation. That will reduce gas consumption. It will reduce stress and pressure on already depleted inventories. There is, of course, the opportunity to import a lot more LNG from Norway, by a factor of 15, 20, 25%. And I suspect we will see the EU doing that. And then, as you said, and I agree, imports from the US from LNG are at record levels, and there is capacity to do more. And so I suspect across a range of different options, you will see the Europeans manage to weather the storm, albeit, as I say, on the economic policy response side, I think EU countries are more constrained than they were 3 or 4 years ago.
Greg, US employers shed 92,000 jobs last month. Stocks have climbed. Bond yields, though, have fallen. The US dollar has weakened across President Donald Trump's second term so far. He's welcomed those movements in the markets, but the war threatens to disrupt that. For a president who frequently refers to market strength as evidence of his presidency's success, what are the risks for him personally here?
Yeah, I think the president, when this war is over, or even before its conclusion, will get back to focusing on the economy. And you're absolutely right. I mean, that's his real, number one policy policy focus. And you saw that in his first term, where you had, massive real wage growth in the U.S. So it's not just the stock market. And I think the Treasury Secretary Scott Bessent talks about this often. It's the parallel growth. It's not just the stock market, it's real wages. We're seeing real wages go up. And in the first term, we've actually recovered some of the wage losses of the Biden years, where wages were down 4%. And so, in President Trump's first term, the real wages were up 8%. And so, that is the real focus. It's not just the stock market, it's real wages. And yes, we're seeing real wage growth already. We did see that 1 month blip in employment, but the prior employment numbers were pretty positive for President Trump. So, I think net, again, back to my context earlier of tax reform and deregulation, and the fact that these higher energy prices compared to the Arab Spring of 10 or so years ago, compared to the Biden years where there was hostility to the energy sector, we are still much lower than those moments.
John, Beijing may be less vulnerable in terms of energy shock, but the country's export machine is exposed to the threats of a growth slowdown to inflation. Will that impact upon China's economy? And what would that mean also for the rest of the world?
Well, that I definitely agree. I think the world's largest trading nation needs a peaceful environment, and it's not a good thing to see these wars breaking out in many places right now, and definitely affects our exports. The Middle East, the Arab countries, Israel, for example. These are huge markets for Chinese exports of electric vehicles, and you can imagine how much of that is being affected right now. So I think definitely I would expect to see March and April exports number to be adversely affected. Now let me also mention that in January and February we're seeing a 20% increase in exports, which is a spectacular number. But inevitably, I think this is going to have an impact on China's exports. So that is why we like to see this conflict to be ended very soon. And I think there's a lot of things we can debate about why this war erupted in the first place, and this is a justified war or not. Right. But by now, John, I think definitely America needs to. President Trump needs to take a step back, and you can't just walk away like this.
Forgive me, John. Forgive me for interrupting. I've got about a minute left, and I just want to get one more answer from Mujtaba. What does Europe need to do to avoid the worst of the energy shock?
I think it is going to try to use the leverage it has against the Trump administration to force it into a diplomatic and negotiating process with the regime in Tehran. And once the hot phase of the war is over and the proactive shooting has stopped, I suspect the Europeans will be willing to play a role in the context of the Strait of Hormuz. So I think the goal is to engage the administration and get the Trump administration to bring the conflict to a speedy conclusion and engage in diplomacy as quickly as possible. And that in turn will mitigate some of the downside economic consequences for the region.
Very briefly, Mujtaba, can the global economy avoid a recession?
Again, it really depends on how long the war continues. Asia and Europe are clearly the most disproportionately affected, and that is very much a function of how long the war continues and whether or not we escalate from where we are today.
Gentlemen, there, I'm afraid we must end it. Many thanks indeed. Greg Swenson, John Gong, and Mujtaba Rahman. And that's our show for this week. If you'd like to get in touch with us, I'm at A. Finnegan on X. Please use the hashtag AJCTC, or you can drop us a line. Countingthecost@aljazeera.net is our email address. As always, there's plenty more for you online at aljazeera.com/CTC. That takes you straight to our page, and there you'll find individual reports, links, and entire editions for you to catch up on. But that's it for this edition of Counting the Cost. I'm Adrian Finnegan from the team here in Doha. Thanks for being with us. Our coverage of the Iran war continues right now.